Okay, good evening, everyone. Again, welcome to another episode of Sequoia Training. Before I start, this weekend we will be in Melfort, Delaware again. Okay, this is the second time we're in the area. So if you have anyone in the area that you would like to invite, feel free to invite them to the training. We will be there in person. So again, the announcement is already posted on Facebook. So go there and take a look at it and register for us. Okay. So let's get the show started for tonight. What are we going to talk about? Tonight, we are going to talk about how to interview our client or how to qualify our client, put it this way. Okay, so let me see if I can do a share first right here. Okay, here we go. So Sequoia platform, if this is the first time that you're online with us, just want to let you know, Sequoia platform, we designed this platform so that you don't need to know how to put the deal together. Okay, as long as you have somebody that needs the funding, put them onto the platform, and we will have advisors to evaluate the deal and tell you if the deal is workable or not and send it back to you. Now, obviously, whatever goes into the funnel and whatever comes out. So what I would suggest everybody do, yes, even though you don't need to know how to construct the deal, put the deal together and things like this. But however, we still suggest everybody to start to learn how to qualify our client. So when we're out there and talking to our client, there are a few things that we need to watch out for. Because obviously, the higher the quality of leads that you put in, the success rate will be much, much higher. For the last 3 or 4 weeks, we see a lot of deal that comes in, But however, I would have to say that approximately 60% of those deals are not workable. And I'm going to show you why tonight. Why are they not workable? Because that will create a lot of frustrations also. A lot of team members saying that, wow, I work so hard out there, putting in all these leads. I promote my website, putting all these leads. But again, how come nothing is closing? It's not because we cannot close deals. It's because the lead itself is not qualified. So again, tonight, I'm going to pick a few products that I would say the hottest product out there that we see a lot of inquiry coming in. So from those products, I'm going to digest and get into detail to explain to you what they are, who should use it, how do you qualify them, and why they can get close and why they cannot get close. Okay, so let's dive into it. And here on the screen right here, as you can see, this is our website and this is our engine. So the most important page that we all should know is the product page. Once you get here, these are all the products that we provide, and we will have more and more and more products. So the first thing, if you are new to Sequoia, I would suggest you to go to this page first to understand what we have, to understand what kind of product that we promote. Now, also, I would like you to click on the down arrow right here, because for every single product that we provide, we have some 3,000 level overview of what the criteria would be. Now, this number by all means, it will change as time goes on, as the economy changes. A lot of these criteria right here, put it onto the website, is for your reference only. So don't take this thing to the teeth, okay? So a lot of these things can be adjusted based on the client's profile. So let's talk about the first one. This one is the most important. We right now currently in Sequoia, I would say approximately 30 to 35% of our loan are from this thing called 1 to 4 unit investment properties. Now, why? In the good times, many people, when they go out there to purchase an investment property, they have a lot more choices. They can go to a traditional mortgage loan officer, they can go to the bank, or they can come to us. And I have a training already specifically talked about how do you invest in residential property using business loan, like what we offer. Now, recently, we have a lot more 1 to 4 unit coming into our pipeline, is just because the interest rate has gone up so much. And a lot of the banks are tightening up their underwriting guideline. That's the fact. And many clients, when they go to a traditional lenders to look for a loan, most of these clients are investors. And some of them already have multiple properties, 2, 3, 4, 5, 6, whatever that might be. In that, in the traditional way, lenders are looking for something called DTI, debt to income ratio, DTI. What does it mean? It means that they will look at that person, that investor's personal income. That's the income. And they also check the credit report and to see how much debt this particular investor has. So let's imagine this investor has like three mortgages, 3 properties, including his primary residence, 2 investment properties, and plus some other debts, such as a credit card debt, car loans, things like this. Now, all those debts will show up on his credit report. So now the lender will look at the total income versus the debt. And if the DTI is too high, the lender is not going to approve them for a loan. Okay. Now, when they come to us, we do not care about DTI. The investor we don't even need him to have a job. He could just come to the United States, just lend in this country, no job, no nothing. But as long as the property that he purchased can produce income, now we can fund him all day long. So that is called DSCR, debt service coverage ratio. So that is what we are looking for on our side. So now, because of the banking industry is tightening up, a lot of the clients that are not qualified to get a loan from the bank anymore. So when they come to us and all of a sudden they realize that, wow, I don't need to show income. I don't need to show tax return. I don't need to show any of my financials. All I show is that, hey, all I have to do just to set up an LLC. And as long as the property can generate income and I can get funding up to 80%. So that is why there's so many clients or real estate agents right now start contacting us. So that is also a good marketing strategy for you too, to go out there to talk to realtors. Let them know your client cannot get a loan from a traditional bank, but through commercial lending, through business loan, we can get them a loan much, much faster. We don't care about financials. All we care is DSCR. And that's what happened out there. And that is why we have so many DSCR loan 1 to 4 unit that come into our pipeline for the last 3 or 4 weeks. Okay. So what should we look for? Now, obviously, the first thing that I ask everybody to look for is the credit score. Now, when we built this website, it was last year. So the credit score is somewhere, I put it right here, 650. Today, if somebody to come to us, ideally, you want them to have at least 660. Now, at 650, can we still do it? Absolutely, we can still do it. But he or she will get much less leverage. So for example, he might be only getting 60% LTV, 65% LTV, versus if he has a credit score of 660 and above, he might get 70% LTV. Or if he has an 800 credit score, he might get up to 80% LTV. Okay. So again, credit score is very, very important. So when you talk to your client, ask them first, what is your credit score? And if the client's saying that, hey, I don't know. I mean, I would say a lot of the client, especially their investors, they know what their credit score is, or at least give you an approximate what the credit score would be. So as long as the credit score is above 660, pretty much all lenders are willing to lend. I'm talking about on the commercial side. All commercial lenders willing to lend, but the interest rate, the leverage might be different. So obviously, the higher the credit score, the higher the credit score, the better the interest rate and the higher the leverage. So that's the first thing that we need to look for is credit score. Okay. Now, the second thing that we look for, it's liquidity. Okay. Now, I also have a lot of a lot of agents come to saying that, hey, Alan, can you guys fund 100%? There's nobody funding 100% loan out there anymore, not even primary residents, okay? We are talking about investment property right here. So in the investment world, in the commercial world, all lender would like to see a client have some liquidity or some skin in the game. So normally they need to put at least 20% down. Now, 20% down, you are talking about a trophy property. A trophy property, what I'm talking about is that in a good area, the price is good, the income is good, so on and so forth. So I would say approximately 25 to 30% of the deal, you can get to 80%. Approximately 25 to 30% to get to 80%. A lot of other deals, majority of the deals is somewhere between 70 to 75%. Okay, 70 to 75%, which means an investor needs to be able to put down at least 25 to 30% down in order for them to get some sort of to get a loan. So that is the second thing that you normally would like to talk to the client is, what kind of liquidity do you have? How much can you put it down? If somebody can tell you, oh, I can only put down 5%, it's not going to cut it. It's not going to work. You know that this deal is not going to close. Okay. So that is the second thing that you need to ask the client. What is your liquidity? How much can you put down? Now, the next thing, it's not listed right here, but it helps when you go into the apply button. When you go into apply button, let me open this up. Right here at the bottom, we ask you, do you own any investment properties? Now, why do we ask that? It's because here in the commercial business, in the commercial loan, the more property that person owns, it means that the more experience that he has, which means the better could be lead to a better interest rate or a higher leverage. Now, if somebody comes in saying that, hey, this is my first time purchasing investment property, can we still fund it? Absolutely, we can fund it. Okay, but some lender might limit the LTV maximum up to 70%. Some lender doesn't care. Now, for the lender that limit the LTV to 70% LTV, that means the interest rate for that particular loan would be much better because the LTV is lower. Now, if there are lenders that doesn't really care, okay, you can go all the way up to 75%, 80% as long as the property makes sense. Now, in most of those cases, the LTV might be, the interest rate might be higher. So also as a loan offer or a loan consultant, remember one thing: the higher the leverage, the higher the interest rate. Excuse me. We always talked about interest rate, right? So a lot of people asking us, hey, what is the interest rate? The interest rate in the commercial world is based on one thing. It's called risk. The higher the risk, the what? The higher the risk, the higher the interest rate. So from the lender's perspective, if I give you 80% versus if I give you 70% of the money, what is more risk? Of course, it's 80%. So hence, the interest rate will be higher. Now, in today's market, what is the interest rate? What is the interest rate? So without knowing anything, we can only say that the interest rate starts at 7.5%, which is very good. Now, can we go lower? Absolutely. We just quoted 7.3% today. 7.3% is a very, very good rate in today's market. Anybody have any idea what is the prime rate today? The prime rate. Okay. This is the number that you need to know as a loan consultant, right? The prime rate today is 8.25%. 8.25%. But for our product, we can go as low as 7.3% right now, or 7.2 in the low 7%, which means our rate is actually lower than the prime rate. Okay, so So that is another reason why a lot of realtors start to come to us, is because our rate, it used to be our rate, because our rate is a commercial rate, our rate is higher than a traditional mortgage. But in today's market, there's not much difference anymore. And we are a lot less complicated. We are a lot less material, a lot less documentations that we need to show to the bank, and much, much faster. Normally for a deal like this, about 35 days, we can get this thing closed. Okay. So that is another things that we need to find out is, do they own any investment property? Ask them, right? So that's the next thing that you need to know. The next thing, it's, do they own primary residence? Primary, do they have a property that they own, that they live in? Now, common sense, that's from the lender, okay? Common sense. For somebody to invest in real estate, most likely their first property, they will purchase it for their primary residence, right? You buy a property you live in first, and then now you move on to purchasing investment property. That is the norm. But some lender, well, let me take out the but first. Some lender would not lend to anyone that does not own a primary residence. Some lender don't do that. Why? It's because we are in commercial lending. We only lend to investment properties. We only fund businesses. We do not fund primary residence. That is a totally different type of funding. And if you want to fund primary residence, now you need to get into licensing. You need to get a MLS. You need to get your mortgage license and so on and so forth. But we are business loans. So all of our lenders are business lenders. They do not like to touch primary residence. Now, what they're afraid of is that if somebody saying that, okay, fine, I'm going to get a loan, I want to move in, and I'm going to get a loan and to purchase this property as an investment. But then after I purchase, I live in there. Now that become a primary residence. Why don't they like it? It's because if for whatever reason, if this person default on the mortgage and the lender needs to foreclose the property, now if he is actually living in the property as a primary residence, it's a whole different ball game to foreclose that property. It takes forever. So no lender would like to touch it. So that is why some lender, once they find out that, hey, you do not own a primary residence, they don't even want to fund to you. Okay. But there are so many other lenders doesn't care, because they do allow people that purchase their investment property, even though they do not own their property. So we are about to close one deal, hopefully next week. So this gentleman right here, he is actually living with his mom. Okay. Living with his mom, but he has daycare business. So he purchased property to run his daycare business. So can we fund it? Absolutely. We have lender to fund it. So as long as we can prove this person does not live in, is not going to live in that property, a lot of the lenders are okay. All right. So that's another things that we need to find out to qualify your client, is that, do you own a primary residence? All right. So this is 1 to 4 unit investment property. We see a lot of those coming in. So those are the 4 things that when you go out there to qualify your client. Number 1, credit score. Ideally, I mean, for me, ideally, I would tell them at least 680 and above, because once you get to 680, the interest rate will be much better. Once you get to 700, even better. So even though when they're at 660, the interest rate, you're talking about somewhere around 8%, 8.25%, somewhere around there. But for the same exact property, if the credit score can go up to 700, now you can drop into the 7s. So it's a huge difference. All right. But anyway, the first thing is credit. Second thing is liquidity. Do they have anything to put down? Number 3, do they own any other investment property? Do they own their primary residence? Okay, so those are the things. So those are the few things that you need to watch out. Now, also, this is extra to share with you. If somebody submit a scenario saying, okay, I'm purchasing a $1 million property as an investment property. And you look at the rent is only like $3,000. It doesn't make sense. Why? Because $1 million property, you are talking about on an average, in order for $1 million property as an investment property, it will your monthly rent is somewhere between $7,000 to $8,000 a month. So from the lender's mind, when you're purchasing $1 million property, they will ask who is going to rent something like this, and especially that property is not in any major major city. Now, if you are purchasing a property, $1 million property, let's say in the Bay Area, in San Francisco, in New York, it's okay. That's fine. You can easily rent out to that kind of money. But if you're talking about $1 million property here in Maryland, in Idaho, in Texas, so purchasing $1 million property as an investment, it doesn't make much sense from the rent. Okay. Now, also, they will also look at, let's say if you already own a primary residence and now you are purchasing $1 million property as an investment, they will look at the property, your primary residence, how much the primary residence is actually worth. So let's say the primary residence, it's, let's say $500,000. And now you're purchasing an investment, $1 million property as an investment. Logically, in the lender's mind, they will think that you are buying the investment property as a primary where you will move to and you will rent out your property that you currently have. Okay. So if that is the case, if they have that doubt, most likely they will reject the loan. So can we still purchasing something like this? Absolutely. We do have a scenario where a client, he already living in a property that's about $1 million. It's in California. I mean, I'm so sorry, it's in Florida. Okay. So he is purchasing another $1 million property a block down the road, and he wants to turn that $1 million property into Airbnb. Now that makes a lot of sense because he's already living in $1 million property. Okay. So again, there's a lot of things that watch out in when we structure the deal. So there's a lot of things behind the scenes that we work that we have to iron it out before we can see that this deal is doable or not. And those are a lot of the small stuff that you don't see on a day-to-day basis, but I'm going to share, I'm sharing with you so that you know why sometimes this deal is not workable, or sometimes that particular property is not a good property to purchase as an investment property. Okay. So again, that is the first thing. It's the 1 to 4 unit investment property. Now, the next thing that I want to talk about is working capital. Now, the working capital will including equipment funding, truck and heavy equipment funding, business acquisition, so on and so forth. We have a lot. I think on a day-to-day basis, we receive at least between 10 to 20 inquiries for working capital. So this is a huge, I can see this is a huge sector for our business. And quite frankly, majority of this working capital that comes into the pipeline is not workable. Let me show you why. So the first thing that we need to look for is this a startup? Okay, a lot of people ask, I see a lot of inquiry coming in. It's a startup, no experience or whatsoever, and they're asking for $100,000. Ask yourself, if you are that lender, if you are the one that writing a check, if somebody comes to you saying that, hey, I need $100,000, but I just fresh out of school, I have no experience or whatsoever, would you give it to them? Most likely not. 99.9% of the time, you're not going to give that $100,000 to that person. No way, right? Because that person has not yet demonstrated he or she has the ability to generate income through that business to pay back the loan. So the first thing that you ask is that, is this a startup, or how many years they have been in business? Now, can we fund startup? Yes, we can fund startup, but let's put that aside. What I'm trying to talk about right here is that how can we close more deal for yourself? When you go out there to talk to the clients, what should you focus on? So that when you submit a deal, we can close it. That is the most important thing. right? So the first thing that you should look for are businesses out there that already been in business for at least 2 years. Why? Because at least 2 years, they most likely they're stabilized. They are able to generate some sort of income. Okay, so 2 years, it's very important. Now, if they have only less than 2 years, then what? Yes, we still have program for it, but 2 years would give you a better chance to get this thing done. So that's the first thing that you ask your client. How long have you been in business? Now, along that same line, ask them, how long has this business been in? How long have you been in business? A lot of people would think that, hey, let's say I own a restaurant, for example, okay? And I own a restaurant 10 years ago, and I owned it for about 5 years, and I sold it. And now I, purchased another one, and I sold it. And last year I purchased a new one, and now I'm running the business. But however, I have been in restaurant business for over 15 years. So they would tell you, you ask them, how long have you been in business? They would tell you that, hey, I've been in business for 15 years, which is true. But you also need to ask the second questions. How long has your current business in operation? So most likely, he just purchased that restaurant 5 months ago. So how long has that business in operation? 5 months. So from the lender's perspective, he only has 5 months of history. Now, he has the experience, no doubt about this. But that particular business, it's only 5 months. Now, you might also say that, hey, okay, I picked up that business. The EIN number never changed. The EIN, sometimes a lot of time when they purchase a business, they do not change the name. And the EIN number would been out there for 10 years. But the owner of the business changed because he just purchased it for 5 months, right? Now, when the lender do a check, they will find out. Okay, so that is very important for you to ask them, how long have you been running the current business? And if only 5 months, then it's 5 months. Okay, so that is important. Number one thing is the history of that business. Now, the second thing that you would like to ask, again, also credit score. Okay, credit score. Now, yes, for working capital, we fund the business, but the lender also look at the person's credit score, personal credit score. Now, if somebody has 500 credit score, 550, can we fund it? Yes, we can still fund it, just the same token. But if they have that lower credit score, the chance for them to get rejected is also very high. So normally, I would look for somebody who has 2 years of experience, credit score at least 680 and above. 680. Now, let me show you why. When somebody to do business, oftentimes they're out there, they would get another loan. They could getting a business loan or an SBA loan or a cash advance loan, so on and so forth. Okay, so if their credit score is low, in many cases, which means that they might default on the business loan sometimes, or they're already in default, whatever that might be. So there's a big chance for the lenders to find out they already have other loans and they're not paying it, and they just want to get another loans to try to pay off this loan. So that is the automatically decline. So when somebody has a bad credit score, there got to be a reason behind it. So if somebody come up to you saying that, oh, my credit score is only 500, most likely for him to get a loan, it's very slim. And that is what we are seeing. We saw a lot of inquiry comes in. The client has credit score 510, 520, 560, 580. And even though they can get loan, they will get a loan that is very, very minimum, a few $1,000s, no more than $10,000. And it has to be somehow collateralized, meaning that let's say they are out there purchasing some sort of equipment and they have a credit score like 550. Can we still fund it? Yeah, probably you can fund him $5,000 $7,000 max, right? So that is why a lot of these clients that come to us asking for $30,000, $40,000, $50,000 equipment loans, but their credit score is very low. We can only fund them like a few $1,000s. They still have to put in the extra money, which they don't have, and that's why they'll go south. So that is the next thing. Credit score is also very, very important. Now, also next thing that you will ask them is, do you have any outstanding loans or debt that you are not paying, or you are in default, or just outstanding debt? Many of them, if they do, now for the last few years, because of COVID, government give out a lot of incentive or a lot of small loans to help out. So one of this type of loan is called EIDL loan. Okay, so many of them, many business owner already got an EIDL loan, but they forgot. So we need to ask them, do you have an EIDL loan? Because a business, just like a house. So for example, let's say a house worth about $500,000 and you have a loan of $200,000. So the equity is $300,000. I might be able to give you more loans, right? But if the house is $500,000 and you have a loan of $400,000, most likely nobody can give you a loan. Same thing with business. Now, when lender fund a business, what do they look at? They look at the financials, tax returns, so on and so forth, okay? So when they look at the tax return and when they realize that this business, let's say generating $1 million a year, for example, and he can qualify for a loan of $200,000, for an example, okay? But if they found out that they already have an EIDL loan for $150,000, now can you still give them $200,000? Absolutely not. In this case, they can only give them approximately $50,000 because they already have $150,000 loan up front. So it's also very important for us to ask them, do you have any other debt? So if you click on the working capital scenario, I believe okay, so there is a question right here. Do you have any other short-term loan or tax liens? If yes, how many loans and what is the total balance? A lot of people forgot to, well, probably they forgot to ask, or they just put in nothing in there. So when they put in nothing, obviously we will assume that they don't have it. So when we do the background check and we found out all kind of liens, and that is also a decline as well. So please pay attention. Make sure that that is the case. Okay. Now the next thing that we need to aware of when you're filtering your client is ask them, how much money do you need for working capital? Right here. What is the loan amount that you need? Now, they can say whatever number, but let's say if it makes sense or not. They can come in saying that, okay, fine, I only in business for about a year. I need $200,000 for working capital. I'm not buying any equipment. I just need to purchase, I just need to purchase inventory, hire more staff, expand my business. Can you get $100,000? I say the chance for that business to get $100,000 is very, very slim, unless this is one of those, big chain that, they make millions on the first year. The way the calculations this, they looked at the tax return. And based on the tax return, the total revenue for that year, the maximum that they will give it to them is approximately 26%. 26%, okay? What does it mean? It means that, let's say somebody that generate $1 million. The maximum that any lender would like to fund them is approximately $250,000. Sometimes you can push it up to $300,000, but I would say somewhere around $200,000 to $250,000. That is more realistic. So in order for someone to ask you to get a working capital for $200,000, and you look at the tax, you ask them, what is the revenue that you generate? If they say they only generate $50,000 a year, no way that they're going to get $250,000. right? So those are some basics. So those are some basic knowledge that we should possess when we go out there to filter our client. Otherwise, when they come in, you got rejected and everybody got discouraged. So you understand why we cannot get this thing funded, right? So those are the few things that we need to pay attention to. So that is working capital. Working capital, it's a no collateral business loan. They only look at the business. Now let's talk about equipment or truck. Okay, let's talk about equipment first. Equipment from $5,000 to $1 million. Now, the first thing that we also look for is how many years they have been in business. 2 years. If they're in business 2 years, very good chance for them to get a loan. Okay, 2 years. Credit score, right here, I listed at 600. Yes, we can still get it, but the dollar amount is very low. If anything that's below 660 credit score, most likely they need to put down some sort of deposit. Now, if you are 660 and above, and you have in business for 2 years, there's a good chance for us to fund that equipment 100%. So which means that they don't need to put down anything. That piece of equipment costs about $20,000, $30,000, $40,000. We give them that much money and they just need to pay a monthly payment. Okay, so it's very important for us to understand. A lot of people come to us saying that, hey, you told me that you can fund 580 credit score. How come they still have to put down deposit? Of course, we can fund it, but we didn't say that we can fund them 100% with that kind of credit score. So again, when you go out there to look for clients like this, interview them, talk to them, make sure that they have a proper credit score. And now the next thing, it's also very important, is invoice. Invoice is we see a lot of cases that came in without a proper invoice. Sometimes they would just write it on a piece of paper saying that, okay, this thing costs $30,000. Now the invoice is important. Why? It's because not only we need to see who the client is, we also need to see who is the vendor. We need to make sure that the vendor is a legitimate vendor. Okay, so the lender will look at the invoice, they look at who the vendor is, they look at the contact number, they will check who are they, how long have they been in business. Now, let's say if there's a new vendor that came out that never sell this kind of equipment before, and all of a sudden now they're selling $1 million equipment, most likely there's a big question mark. Who are these people? The most, what the lender afraid of is this. In equipment loan, let's say the equipment costs about $50,000. They do not send the $50,000 to the client. They send the $50,000 to whom? To the vendor, okay, to the distributor, whoever that might be. And once they take the money, the distributor will ship the equipment to the client. And now the client start to pay the monthly payment. So that is why they need to make sure that the vendor is legitimate. And if the vendor is not legitimate, they send out the money and they disappeared, now everybody's in trouble, right? So that is very important. That's the first thing. Now, the second thing is that we do have a lot of clients that is purchasing product overseas from India, from Pakistan, from Mexico, from China, from all over the place. Now, can we still do it? Only if the vendor has a US-based office that we can verify, then we can do business. We cannot send money outside of the United States. Okay, so that is very important. So that is equipment loan, okay? That is how you qualify your client. Equipment, we got to have invoice. Now, what if the client does not have 2 years of history? Can we still do it? The way to do it is that in that case, we need to make sure the clients in that industry for at least 2 years. So for example, let's say the client saying, okay, fine, I'm open up a restaurant right here. This is my first restaurant. I used to work for a restaurant somewhere, and now I'm ready to come out here to do my own thing. Can you do it? Yes, we can definitely fund you equipment. Okay, not working capital, but equipment. So they have to provide 2 years of tax return to show that they actually work in a restaurant, that they're getting paid. In that case, now it's okay. Then we can fund them. But of course, we also need to see their bank statement also to make sure that they have the liquidity to support that loan. So we do need to see 2 years of tax return and at least 3 months of personal bank statements to qualify for equipment like this if they have less than 2 years of history. So that is equipment. Same thing with truck. Now, the most important thing for truck, the biggest issue that we see is also credit score. We have a lot of people that apply for a truck loan. They have the experience, no doubt about this. We can see it. But however, somehow, somewhat, a lot of these people, their credit score is just very, very bad. Below 600, below 600. So for truck, most lender is looking for at least 660. Now, heavy equipment, it could be as low as 600. But for truck, most lenders looking for 660 and above. Now, we do have lenders, is what we call the subprime lenders. They don't care about credit score. Okay, they will fund anybody, but the maximum that they will fund, it's 50%. The maximum they would fund is 50%. So if anybody out there, they're purchasing a truck that is $100,000, for example, and their credit score is like 500, okay, fine, I'll give you $50,000, and you have to put down $50,000. So that is what happened. And also, when you purchasing truck, most lender do not like to fund old trucks. What is old? Anything that is 15-year-old, they don't want to fund it. So that is why on that invoice, we need to see the make and model year of that particular truck. Okay, in order for us to qualify for it. So again, that is something that you should pay attention to when the client send in the documentation, and if you see something like this, and now you know why it's not working. But on our side, after we reviewed it, we will let you know why we cannot fund it. So the majority issue that we see is credit score is low, and most important is the credit score. And that is why if the credit score is low and they want to purchase a truck or get in working capital, help them out. Have them to fix their credit first. I mean, we provide a service on our platform. Okay, but if they don't want to use our service, that's fine. There's so many other people that can provide services out there that can help them to fix credit. So it's good for them to have a good credit score above 660, and it's much easier for them to get a loan. So that it's truck and working capital. Business acquisition, that is the same thing. We want to see how long that business in operation. Now, we have occasionally people that come in saying that, hey, I'm buying a gas station, and that gas station only in operation for about a year. You make a big question mark. Why that business is only in a year and then now they sell? There got to be a reason behind it, right? The lender is going to look into it. So normally, when you out there to purchase businesses, lender would normally look at 2 years of that business that you're purchasing, 2 years of tax return to make sure that if that business worth that much money. So they go out there saying, hey, I'm going to purchase a flower shop. I'm going to purchase a daycare business, whatever that might be. So without 2 years of tax return, the lender is very difficult to evaluate the true value of this business. You can say, hey, the business worth about $1 million to me. Right. But again, how can you prove that business is worth $1 million? So 2 years of tax return is very, very important. So that is what we're asking for. Also, for purchasing business like this or open up a new business, we also have people come to us saying, hey, Alan, I want to open up a new restaurant. Okay, fine. Now, what you should ask them is that, what is your experience? who is going to run this business after you purchase it, and what kind of experience do you have? Now, give you a example. We have a client right here. It's purchasing a security business in Las Vegas. What is security business? When you walk into all these casinos and you see a lot of these big guys and, carrying guns and walking around, those are the security guards, right? So they belongs to a company. So this gentleman right here is purchasing one of those business. Now, the lender will ask, what kind of experience do you have? And it turned out to be that he's already running a hotel business, that he's managing a lot of staff and things like this, that can show that he has so even though it's not the same line of business, but it's more like a management type of business. So to the lender, that is okay. All right. Also another example, a chef that used to work in a restaurant, and now he come out saying that, okay, I'm going to purchase a business. I'm going to start up a restaurant. Now the lender rejected that. You know why? It's because as a chef, most likely the chef only deal with kitchen, inside of the kitchen, okay? He might know where to order all the different supplies and materials and things like this, but he cannot demonstrate that he has the experience to run a restaurant. Because when you're running a restaurant, it's a lot more than just a chef, right? You have to be doing marketings, accountings. You have to do a lot of dealing with customers, dealing with staff, management, so on and so forth. So the lender rejected that deal. Then he pulled in someone who worked as a senior manager in a restaurant. Now the deal got through. Why? Because now the senior manager on a restaurant is actually running the business, not just the chef. So for the combination of those two, actually make the deal much stronger. Now you have somebody that knows the back end. Now you have somebody understand the front end. So experience is also very, very important. So again, many of these deals that did not get closed is because they cannot justify the experience. And also another thing the lender would like to see is, how do you run the business? So back to the example where the gentleman is purchasing the security business. The business is where? It's in Las Vegas. Where is the gentleman live? He's actually in California, in 2 different states. Now the lender's asking, how can you run this business when you are in California, but your business is in Los Angeles, in Las Vegas? And it turned out to be that he has a second home in Las Vegas. He can show that I have an address right here, and I stay 50% of the time in California and 50% of the time in Vegas. Okay, that's fine. So in that case, the deal goes through. So again, those are all there's a lot of details in processing the loan or underwriting the loan. And those are the things that we don't see. As a loan consultant, you don't see on a day-to-day basis, but that's what we deal with on a day-to-day basis. Okay, so let's wrap it up. It's already 8:50. I got 10 more minutes. Wrap it up. Regardless, it's 1 to 4 unit or fix and flip or single family home, whatever that might be. Always pay attention to the following. Number 1, credit score. Absolutely. Credit score is very, very essential. Number 2, experience. Experience is very important. Number 3, liquidity. How much money do you have? How liquid do you have? Okay. The lender is not going to give you 100% loan. You got to put money into the in the game. So liquidity, that's the next thing that they want to see. Okay. So those are the 3 most important things that any type of loans, when you go out there to talk to the client. So hopefully tonight, after I explain something like this, you have a better idea how to interview your client. So talk to them. Always don't be afraid to ask them how much money you need to put down. I mean, I do a lot of Zoom calls like this with clients. They come up, they would tell me all kind of crazy thing about their project, or how good this project is, and so on and so forth. That's fine, no problem. The first question I always ask them, how much money do you need? They're saying, okay, fine, I need 5 million, I need 10 million, I need 500,000. Fine. The second question I always ask, how much of your money can you put down? And if they say, oh, I don't have anything, sorry, I cannot do this. Okay. I would suggest them to remember, we are lenders. We are not investors. Those are two different concepts. A lot of people think that, hey, you are lender, investor is pretty much the same thing. You guys got the money. Yes, we got the money, but it's two different things. We only invest in successful business. We do not invest in, we only lend to successful business, successful projects. We do not invest in an idea. Does that make sense? If somebody come up to us saying that, hey, I got this idea, I can do this. Oh, when I build some, oftentimes you will hear something like this. When I build something like this, my future income would be this. It doesn't work that way. The lender would not give you a loan based on your future performance. The lender will only look at what you have right now. And based on what you have right now, they will give you a loan. Or is this still doable or not? So don't be afraid to ask your client, how much money can you put down? How much money can you show that you have? And if they cannot show anything, or if they cannot show enough, most likely it's wasting time. So move on. Okay. We cannot help everybody. We want to help everybody, but the reality is that we cannot help everybody. So it's very, very important for us not to wasting our time. If let's say if they really don't have anything to put down, okay, ask them what kind of collateral do you have? And especially for startup, a lot of the startup company, a business come to us saying, hey, Alan, can you give me this? Can you give me that? I don't have experience. I don't have this. I don't go. So I would ask them, what do you have? As a lender, my concern is that how can you pay me back that loan, right? So what kind of collateral do you have for me to utilize it as a collateral to give you that loan? And if they say that, oh, I have an investment property that's free and clear, ta-da, yeah, I know that I can definitely give you the money. And if somebody's saying that, oh, I have about $500,000-$600,000 in 401k, okay, no problem. I can definitely convert that 401k into working capital for you, right? So again, don't afraid to ask. Ask them, what do you have to show me that I can give you that loan? Okay, guys, so that is all I have for you tonight. I can go on and on and on and on, but I just want to wrap up with those three most important things: experience, liquidity, credit score. All right. So now, obviously, there's a lot more behind the scene. No doubt about this. There's a lot more behind the scene. But again, those things, if you can get through those three, the other thing would be easy. So I see a hand right here. Stephanie, please unmute yourself.
All right. Well, I have a quick question. Thank you so much, Alan, for all that information. Quick question with regards to, you had talked about the liquidity, you talked about the credit score, how much money they have. When they're looking at those tax returns, so you talked about the experience, but basically when the business started, so at least 2 years with the business, with their EIN, with their LLC. On a tax return, I thought in many cases the LLC show no profit or something like that. So what specifically are they looking for, I guess, from their tax return? Is it a net income? I missed that. And I want to make sure I understood that.
Very, very good questions. So what exactly are they looking for when they look at tax return? They look at two numbers. They look at the top line, they look at the bottom line. The top line is how much they bring in, the revenue, the gross revenue, right? The bottom line is after they have all the expenses right off, what is their net profit? Now, if their net profit is negative, they will dig into deeper to look at what kind of write-off do you have. Are some of this, because again, business owner, we write off a lot of things. A lot of business owners make money, okay? But on paper, it just doesn't look good. That everybody knows about that. So they will look at what kind of write-off that you are having. And if they feel that many of this write-off is actually not a write-off, meaning that you can actually support the loan, they will still qualify you. But if all those
Okay.
write-off are actual write-off, then you still have a negative profit, then obviously they would decline it. So that's the first thing that they look at. The second
Okay.
thing that they look at is the trend. That is why normally they look at 2 years. They want to, I mean, sometimes they ask for 3 years, but now they ask for 2 years because COVID is pretty much behind us. They want to see for the last 2 years, it's your business in an increasing trend, or is it a decreasing trend? So if the business is increasing, yes, there is a big chance for them to give you that loan also. Okay, so that is what they look for. Now, obviously, if somebody that have a negative income or negative net profit, they also will look at another piece of instrument is the year-to-date profit and loss statement for 2023.
Okay.
Right. So again, that is what they looked at.
Okay.
Right.
And for individuals that have two businesses, same type of industry, but different states, right? So they have one for one state, one for the other, they're neighboring states, but for the sake of, and it's around, investment properties and things of that nature. So it's the same name, but one for Delaware, one for Pennsylvania. If they're looking to, I guess, go for a loan, or if they need the working capital, are they able to do it for both if they have two individual EINs? Or
Yeah.
since it do tie back to the individual, is it basically one loan since they're looking at that one person to guarantee the loan?
Okay, very good question. Yes, the answer is yes. They can get 2 loans because there are 2 EIN numbers right there.
Okay.
But okay, if you have multiple businesses, the lender is going to look at tax return for all the businesses. Let me tell you why. Let's say this guy got 3 business, for example, A, B, and C. Okay. So A is doing good. B and C are not doing good. So now he go out there using A, saying that, okay, give me $100,000. And he know based on A, he can get $100,000. Now, what the lender afraid of is that he will get $100,000 through A and use that money to fill in the blank for B and C and fill the hole for B and C. Does that make sense? So that is why the lender would like to see all 3 businesses financials, and they would do a determination based on the entire profile. And yeah, you're right. In some cases, the lender is going to reject the loan because the other 2 might be losing money. Okay.
Thank you so much. Appreciate it.
Yep. Thank you. Donald, can you unmute yourself?
Thank you, Alan. As usual, your training is awesome and very good information. I have a client is looking to do a BLOC. Do we do BLOCs, and what is needed for that?
Business line of credit. Yes, absolutely. So for something like this, you submit it through working capital. Okay. Just let us know that on the note section saying that the client needs a BLOC. So for BLOC, relatively easy. They will look at 6 months of business tax return. I mean, 6 months of bank statement and an application. That's it. So based on that, the lender is going to determine if they can qualify for a business line of credit, how much would that be, so on and so forth.
Is there a certain limit on the amount?
Again, that is based on the company's business income to see what their deposit would be. So, I mean, if they can go all the way up to $1 million.
Okay.
But your company got to make sense to get $1 million line of credit.
Okay, great. Thank you.
Right. Thank you. Gigi?
Hi, thank you so much, Alan. I just had a question. So trying to understand the difference between, why someone would come to Sequoia versus a bank, or what would be the distinction?
Okay. Let me ask you this. Have you ever purchased a house?
I have not.
Okay. let's assuming today you are buying a house,
Uh-huh.
or yeah, you're buying a house. Do you go to a bank to get a loan, or do you go to a broker to get a loan?
I don't know. I know bankers who do those, so
Most likely
that's
you
what.
go to a broker, right?
Uh-huh. Okay.
Why? Because you go to a bank, the bank can only sell their product.
Ah, okay.
You might not be able to qualify for that bank. Now,
I
let's say
see.
you go to Bank of America say no. What do? You go to
Uh-huh.
PNC. PNC say no. What do? You go
I
to,
see.
now, do you
Uh-huh.
have the time to do all these?
Right. No. Okay.
But when you
Yeah.
go to a broker like us, we
Uh-huh.
have so many different lenders, and we know the lender's guideline. So when
Right.
we look at the client's profile, and now
Okay.
immediately I can tell them, what can I do for you?
Okay.
That
Got
is
it.
why we are here.
Okay.
All right.
Thank you. Yep.
There's quite a few messages in the checkbox. Let me see. Anyone know the email address for Sequoia? Now, what kind of support at setlending.com? Thank you so much, Mr. Thomas. Do they have to show liquidity 20% to get approved? Okay, so for approval alone, let's say you purchase a 1 to 4 unit investment property, and let's say we can only fund you 80%, and you need to put down 20%. Yes, we do need to see that 20%, and that 20% got to be in an account that the client can control. Now, remember, we are business loans, okay? The client could have money all over the place. They could be in their personal account, could be with their joint account with the wife, or could be another business account with another business partner. It doesn't matter. As long as that account, he can control that account, we can count. But the money got to be in an account. Cannot be saying that, oh, I have 20% equity in my house. It doesn't work that way, okay? Now, also somebody saying that, hey, I have a HELOC, a line of credit with my for my home. Okay, I have a $300,000, and I use that $300,000 HELOC to purchase this property. Can I do that? Yes, you can do that, but that HELOC has to be taken out and put it into your account in order for the lenders to verify it. So in order for you to show, yes, we can do that. Do you make exception in some cases? Always make exceptions. For example, I mean, again, same thing. If you're talking about purchasing an investment property, especially when you're talking about bridge loans, hot money, and things like this, let's say the credit score dropped. But this guy has tremendous amount of experience. Yeah, we can definitely look into exceptions. Or another example, for 1 to 4 unit investment property, and let's say the guy locked in an interest rate at 7.5%, whatever that, for example, and now the interest rate has gone up, and now the interest rate gone up to 7.8%, but he was locked at 7.5%, and now the lock expired. Now, can we get an exception? Yes, we can always get exception, but again, it's always case by case basis. Okay. Do we provide funding for BLOC? Yes, we do. For working capital, normally what percentage of revenue the lender can fund? I mentioned it to you. Working capital, approximately 25, 26%. What are we able to help if bank denies loan? Ah, man, we love it. We love it. That is why when the bank say no, we say yes. I mean, majority of our clients are non-bankable client, meaning that they go to the bank rejected them, they come to us, and as long as the project makes sense, most likely we can funding for them. And as a matter of fact, right now, a lot of the banks are not funding many projects out there. So that is why we have so many agents, real estate agents, come to us right now, just because their client is not getting the loan from the bank anymore. And now they come to us to get the loan. Okay, 1 to 4 unit need to be held under LLC. Any exception? Very good questions. We are business loans. 1 to 4 unit investment property need to be under LLC. Are there any exceptions? Yes, we have a few lenders allow you to purchase investment property under your personal name, but it's definitely not suggested. Okay. Few reasons. Liability. When you are an investor, you're supposed to put your property under an LLC to protect yourself. Why? Again, if somebody break the arms in the investment property, they will have legal actions against the property. Who owns that property, they will go after that person. If that person owns the property under a personal name, and all that person's asset all the assets will be liable for a lawsuit. But if the LLC owning that property, that person is just the owner of the LLC. Now what they are suing the LLC, is not suing the person. Okay, so now it protects me. It would not, my personal assets would not exposed to the lawsuit. So that's very, very important. Now, that's one thing. The second thing is that all of our lender will fund property under LLC, and many of them have very good rate. But we have a few lenders that will fund personal. So if you want to purchase a property under your personal name, we can only use those few lenders, and their interest rate might not be as good as other lenders that fund you under LLC. So again, it's a good practice to fund it under LLC. Oh, thank you so much. I hope you like it. Would a food truck purchase be considered as equipment funding or business acquisition? Okay, food truck is heavy equipment. Heavy equipment. As a matter of fact, we just funded a food truck this month. Okay, heavy equipment. So make sure if they're purchasing a food truck, the person got to have at least like 2 years of experience. Much easier. Sequoia only fund to companies, so the borrower has to be an LLC. Okay, yes, absolutely. Okay. So again, those are all the questions. Anything else? Anyone else? Stephanie, I still see your hands up. Do you still have another questions? If not, ladies and gentlemen, thank you so much for tonight. And that's another episode. And that's what Sequoia is all about. We are here to show you what commercial lending is all about. And we are going from city to city to city to city. So please help us to share our company with as many people as possible. There's so many other business people out there that needs the funding, and yet the bank is not funding them anymore. So come to us. We always have a place, have the funding for them. So again, ladies and gentlemen, thank you so much. And we see you next week.
Thank you so much, Alan.
Waiting on you to come
Fantastic.
to Houston.
Thank
Yes,
you, Alan.
absolutely.
This is
Alan, great show. Great
From
job, Alan.
Michigan.
Leonard from San Jose.
Absolutely.
Thank you, Alan.
Thank you so much.
Yeah, you did good.